enable.
Achieving your goals and dreams requires a lot of perseverance and commitment. After all, it involves specifically mapping your financial goals and then managing your finances to achieve those goals. And we're here to help you do just that. Hello and welcome to NSE FinWiz, powered by CNBC TV 18. I'm your host, Gautam Srinivasan, and today we are at the offices, or rather the headquarters, of one of India's biggest retail giants, the Future Group.
Founded in 1987, Future Group is a pioneer of modern retail in India with an employee base of over 36,000. The company, with its multiple retail formats, connects a diverse community of Indian buyers and sellers through its organized retail models. NSE FinWiz, with its theme Dream On, engaged with employees of Future Group to understand their thoughts on financial planning and wealth creation.
I think this is a fantastic initiative by CNBC and NSE to do the NSE Wiz, and I think we are very honored that you're doing it with Future Group because this also gives our Future Group employees the chance to really get a preview into how financial planning, financial literacy actually takes place.
Hello and welcome to NSE FinWiz, powered by CNBC TV 18. We are at the offices of Future Group to talk about money management and the ways and means to improve your money management. And today's topic of discussion is savings versus investments. And to provide their insights on the topic, we have two very special guests. We have Kalpesh Asher, founder of Full Circle Financial Planner, and we have Mehrab Irani, General Manager Investments at Tata Investment Corporation. Let me start with you, Mehrab, here. Now, savings and investments both have value for different reasons and purposes. So, could you outline the key difference here? It's not like one is exclusive and not required at all. So, could you outline that difference for our audience today?
Saving and investment are two distinct functions. I think saving is just the beginning. Whatever salary or whatever income we have to save a certain portion of that. But once we save that, I think the next step is to invest. Unless we profitably invest, we are not going to reach anywhere. And if long term we just remain savers, then in the long term I think savers would be losers.
All right. Somewhere has simplification played a part in encouraging a lot of people to go through the investing route? Because earlier, when it came to savings, it's just about storing your money in the bank account. It'll earn some interest, or maybe put it in FD, and that'll be enough.
Saving is nothing but your emotion, and investing is your action. Okay, so you can be a brilliant saver and have a feel-good factor that you are doing all the good things in life, but that's just a feel-good factor, and the story ends there. What is it that translates into growth? That is nothing but investing.
I think saving has to be a compulsory thing. Unless it becomes that, I think it will be very difficult for you to save. So at least save minimum 20% of your salary. Also, when you do goal planning, you have different short-term, medium-term and long-term goals. So accordingly, you bifurcate your saving and investment between your different goals, so that at different points of time in your life, you are able to meet those goals with your available and accumulated funds and investments.
That's an important point there, because we usually associate goals with investments, but not usually with savings. Isn't that also a required component, that when you save something, you should also have some goals associated with why exactly are you saving or earmarking this money, which could have otherwise gone into investments?
In certain cash flows, we imbibe into the prospective investor or a client that consider your investments also as a part of your cash flow. Consider that as an expense, that it has to be done mandatorily, like what Mehrab said, according to a certain percentage. So if you divide your cash flow into a 100% basket, you might be having 25 to 30% as EMIs. You might be having 50% as your mandatory lifestyle expenses. 15 to 20% has to be investing. After that, if you're left with something, I think you're in a very green zone.
All right, time now for questions from the audience. I'm going to list out your names and you can get up and ask the question that you have on the topic of savings versus investments to our experts. The first name I will be calling out is Karun Gupta.
My question was that as a young professional just beginning,
what should my savings versus investment plan be, since I have a fresh start at it? So what factors should I be looking at in order to take it forward from here?
So it's up to you, it's your prerogative that you do an introspection about what is at this stage of life, what is your immediate requirement. So if you want to attain those goals, short-term goal, then you have to put your money in debt funds, fixed income funds. Equity is a strict no. If you then want to plan out something for 3 to 5 years, you want to get married in that period, then our horizon also of advising spreads. And then you can have probably a 50% exposure to a debt and equity type of a component. But surely if you're planning for something which you don't want the money for the next 5, 10, 15 years, equity, mutual funds is the answer to that.
I would like to say one thing that, you should not confuse insurance with investments. I think both are very separate things. Insurance covers your risk, while investments help you to grow your capital. So everybody should take an insurance policy. I think each and everyone should take a proper insurance policy, and the best answer is the term policy.
All right, our final question for this segment comes from Shobhit Tiwari.
How do we cope up with the investment and the saving? And similar way, we can do things like which are kind of luxury kind of thing, but that has become necessity in this phase of life.
First of all, on the life aspect, please term your happiness quotient very well. Do things which make you happy in the real term. Just because your colleagues do it and you wish to do it, I think that's not the right way to do it. Find that inner happiness on what makes you happy, then pursue it. Once you are done with that, surely you have to then look at the financial cushion. Because if you do not have a financial cushion, believe me, at some point of time it will catch up with you. And all that happiness and everything will evaporate into thin air. So having a financial cushion is very necessary, and it all boils down to that topic of today, which is savings versus investment, and a certain percentage which we are keeping. So as I said, so if you don't have a liability towards EMIs, and I think you're in a happy zone if you're not, you're not borrowed money, then you have a more extra space in your cash flow to devote towards lifestyle expense. If not, if you have a borrowing, then 20-25% is going towards that. 50% you will surely need towards maintaining your normal mandatory expenses. You can't run away from it. And the remaining 15 to 25% gap which you have in your cash flow has to be invested in the means which you have linked for your goal.
All right, on that note, we'll take a short break. When we return, we'll be dwelling deeper into the wealth creation aspect of this whole savings versus investments debate. Stay tuned to CNBC TV 18. Welcome back to NSE FinWiz, powered by CNBC TV 18. Now, in the first segment, we discussed savings versus investments. In this segment, we'll be dwelling into the aspects of financial planning and goal setting towards savings and investments. So let's begin with, how to decide how much of, what share of savings to dedicate to long-term versus short-term investments. Kalpesh, if you could give us sort of a tip sheet to folks here, how can they go about it, and what's the best route to achieve all their goals? What would you say to them?
Okay, so if we just probably want to do a demarcation of the products, or how do you, target your long-term goals and how do you target your short-term goals? We've missed out on one component which is very integral part, is the contingency fund. I think that is the shortest term goal which everyone out here should be having. And contingency fund is nothing but actually keeping a lump sum amount of, which is nothing, I think more than 3 to 6 months of your expenses set aside. This amount is not for earning great returns or something, but this is for your rainy day. So in case if there's a job loss, there's a unforeseen expense, you can always tap into that reserve and not take any haphazard decision out in a haste or something, break your investments or go for a loan and all such things. The better option which we suggest as financial planners is putting the money in a liquid fund, liquid mutual fund, which always gives you a couple of percentage more than your savings account, and it is easily withdrawable. Any point of time you can use that, or simply if you're uncomfortable with anything, just keep that money in your savings account or a normal FD, but keep that money not with the intention that it has to earn money, but it is for my rainy day. Today we have FDs, the rates which are falling by the day, and it's not at all become a lucrative medium of investment, and post-tax I think the returns are really, really negligible and pathetic. So we have an option in the debt mutual fund category. Now when you look at the debt mutual fund category, it's in the fixed income space, and today we are fortunate that in the taxation aspect, after a period of 3 years, the debt mutual funds offer a better tax efficient return than a bank FD. So debt mutual funds, you all should look at it. Coming to the long-term goals, if you are astute, if you are experts in playing direct equity, buy stocks. But how many of you all are? Not many people are astute or exactly, hit the target every time in buying a direct stock. Because for that you should have time on your hand, comprehensive research, luck, and some money to lose in the beginning.
Made some people think as well, because earlier real estate used to be the favorite play. Now the question becomes, if I liquidate my real estate portfolio, there is always the long-term capital gains tax factor there. But there are ways to, kind of mitigate the tax implication there and bring a non-liquid investment into, fairly liquid investments. What would you say? What would you advise to the audience on that if they want to shift from a real estate portfolio to a more liquid portfolio? And how can they do that saving taxes?
There are some options when you sell real estate. There are some provisions when you can save tax also. But most of them are, I think, again, investing back in something like real estate or some kind of a bonds. But equities are obviously, as Kalpesh very rightly said, that they give very tax efficient long-term returns because they help you to participate in the growth of the economy. So when you invest in an equity, you are investing in a business, you are participating in the growth. So I think it's very important to invest for the long terms.
All right. And following up on what you had mentioned earlier, Kalpesh, now when times are uncertain, sure, the value of a savings, a nest egg is obviously there. But the question is, once you build up a sizable savings, somewhere, and the times are certain where your job security and everything, you have an assured source of income. The question is, what's next? Because you will be looking at that huge savings nest egg and wondering what to do, maybe pay off some loan or something that I have. What are some of the rookie mistakes people make when they build a sizable savings?
I think the biggest mistake is fluctuating your goals. I think shifting the goalpost, that you might say for the next 2 years, I have a short-term goal. Now, at the end of 1 year, you might shift that to a long-term. What has happened is you basically converted your instruments which you've earmarked for a certain purpose into a different purpose. You've shifted the goalpost. I think that discipline needs to be inculcated at a very, very, inception stage when we start investing.
And before I toss to the audience, I'd like to get your view, Merab, on one of the most important long-term goals, which is retirement. What should be the balance of savings and investments when approaching that long-term goal, which is, say, having a retirement fund?
Yeah, clearly when you are beginning at, say, 25 or 30 years, you are planning for the next 25 to 30 years. So clearly in the initial stage, it has to be maximum portion into equities, because longer-term equities are no doubt the best asset class which will give you growth with maximum tax benefits. But as you slowly move towards your retirement, towards your goal, then slowly, I think you have to shift out of equities into more stable. First you shift a certain portion into balanced funds, and slowly you shift into more liquid, more safer assets, and safer in the sense less volatile assets. There is a difference between safety and volatility. Equity may be volatile in the short term, but very safe and the best investment in the long term, because it will help you beat inflation with tax breaks.
All right, it's time now to get the audience views in on their goals and see how our experts can help them achieve their goals. So I'm going to be calling out the first name. If you could get up and list your goal that you had in mind, we can see how we can help you achieve that. Mr. P. Vishwanath?
Two big goals that I seem I'm not prepared. One is my kids' educations. I have two of them, so how do I prepare for that? And second one is obviously retirement. Till now, I've not really seriously thought of planning for retirement.
On the financial front, understand one thing, that today education inflation is something different than the normal inflation. So we are talking about an inflation which is growing at 10 to 12% every year. So your targeting should be at that inflationary amount. And I think today everybody of us in India should worry about our retirement. You have an education loan, you have a personal loan, you do not have a retirement loan. If you want to reach a corpus of 5 crore rupees, okay, by the age of 60, if you have started that process at the age of 30, you've given yourself 30 good years to invest at the growth rate of 12% per annum. Again, I'm being conservative. You will need a monthly SIP of 14,000 rupees. If you've deferred that decision by 10 years, you're 40. So this is applicable to you. And if you want 5 crore rupees, your target right now is around 40 to 45,000 rupees per month. So one is 14,000, one is 40 to 45,000 rupees per month. And if you still do not do anything for the next 10 years and you want to reach that target, you start at 50. you're looking at a monthly investment of 2,15,000 rupees. So the simple mantra is start early.
All right. Moving on to our next audience member, Rutuja Jadhav.
My goal that I've mentioned is that I would like to start up, maybe build a corpus fund 10 years from now at a saving of about 50,000 per month.
So you want to accumulate about 30 lakhs and you've got your saving power on a monthly basis is around 50,000.
Including all.
And I think with 50,000 per month of savings, if you do in a proper equity and growth fund, I think you will be able to achieve much more than what you are planning to do. So even at a 10 to 12% conservative rate of return after tax, I think the corpus will be much higher. So I think since 10 years is a decent time, it can be classified as a long-term growth, and this you are planning for your future business or startup, whatever, as you said. So I think maximum portion just now you should invest in equity and equity-related mutual funds and products. Once you are closer to your goal, say around 8 to 9 years from now, then slowly you can shift that towards fixed deposits or liquid funds, which are much lesser volatility and offer better safety.
I hope we've answered your question. On that note, we'll take another short break. When we return, the floor is open to all the members of the audience here at Future Group, where they will be posing questions to our experts and get them answered. Stay tuned to CNBC TV 18. Welcome back to NSE FinWiz, powered by CNBC TV 18. Well, the floor is now open to the audience, the professionals here at Future Group, to pose their questions to the experts who we have with us. So, questions from the audience, ladies and gentlemen.
Do you think this is the right time to invest in stocks, considering most of the stocks are at the peak? So, it's the right time to invest stock or wait?
That's always the most important question. When do you time yourself to say, okay, now is the right time to buy those stocks? What do you think?
We all go by PE valuations and all those, fancy terms. 100% they're important. But I don't think anybody can put his finger and say that we are at an all-time high. The markets are going to crack. The markets are going to move. So I don't think that's the right way to look at things. It depends on two things. Where are you at which stage of life right now? And what is your time and investment time horizon? What is your risk profile? What are your goals? And then you decide.
All right, let's move on to the next question.
I've been a long-term investor for past 20 years. That I want to have, for example, a fixed amount coming to me every month. Okay, so there is a goal which I'm already working on, which is having so much corpus at the end of 60 years of my life. Okay, which I am working and I am in progress of it. Now I want to start another goal, which is basically getting a fixed amount, okay, every month into my account. Okay, what are the tools to basically start working on that?
You should be aware of the fact that in mutual funds, when you expect a dividend payout, okay, there are two options. I'll first talk about the dividend payout option. In a dividend payout option, the funds which are paid are obviously tax-free. Now that's one good advantage which you have. And the most important aspect to be understood here is that what is coming to you is actually return of your own capital. So dividend payout is brilliant. In equity funds, you are, as on today, getting 7 to 8% type of a dividend yield, which we call. The other option is same thing happens in a debt mutual fund. Obviously, the yields are much lesser than that. The second way is a systematic withdrawal plan, which is that you designate, like in what you do in SIP, which is a systematic investment plan. You had an SWP, which is a systematic withdrawal plan. If you want growth, then cumulative is the best way.
Okay.
Because you talk about a compounded rate. But if you want regular income, then obviously the returns are going to be much lesser than that on a longer period.
Okay.
All right, on that note, we'll conclude this episode of NSE FinWiz, powered by CNBC TV 18. The theme has been savings versus investments. I'd like to thank our guests for sharing their insights on the topic, the audience, of course, for very engaging Q&A, and the viewers for tuning in. We'll be back with another episode and another theme on financial planning. Stay tuned to CNBC TV 18.
The session made me more aware about various options of investing, how to invest and where to invest. in the future, I'd really like to go on and explore such options.
We got very valuable insights from the financial experts today on the dais. These insights are especially important for the common man like me, who does not, get in-depth financial advice usually or in a day-to-day life.
It was a fabulous session. Like, there were a few points which were being brought up for a discussion where it spoke about long-term, short-term planning in terms of your investment. It did help me. It gave me a lot of insight about how to plan my investment and go ahead with it, depending on my age, depending on my long-term or short-term goal, which I'm putting up for myself.
Focus, ideate, innovate, enable.